Welcome to the Deep Dive, your shortcut to being truly well-informed. We dig into articles, research, expert notes. Basically, we pull out those crucial nuggets of knowledge.
Stuff that really makes a difference.
Exactly. Today, we're diving into the bullish case for Bitcoin. We're drawing a lot from a really key 2018 paper by Vijay Boyapati, and we've got a bunch of charts too. Helps visualize things. Our mission, look past the daily headlines, the price jumps and drops. We want to really get the foundational arguments for Bitcoin.
Understand its history, its unique features, where it might be going.
Right. And definitely keeping an eye on the risks too, because let's be clear, this isn't investment advice.
Absolutely not. Think of it more as an intellectual adventure. It's about understanding a pretty significant technological and economic thing that's happening.
And that 2018 paper, even though it's a few years old now, it sets up this amazing framework, doesn't it, for understanding money itself.
It really does. It's almost timeless in that way.
Yeah.
It gives you a lens to see how Bitcoin fits into that whole grand story of value, way beyond just, this one digital asset.
Okay, let's unpack this then.
Yeah.
Because for a lot of people, Bitcoin is still, well, it's a bit mysterious, isn't it? Just a number on a screen, maybe a buzzword. What is it, fundamentally?
So at its heart, Bitcoin was this incredible solution to a really old computer science puzzle. It's called the Byzantine generals problem.
Okay, sounds complicated.
Yeah, the name is a bit much. But imagine a bunch of generals surrounding a city. They need to agree, attack, or retreat, but they can only communicate by messenger. And crucially, some of them might be traitors sending false messages. How do they coordinate without a central commander they all trust?
Right. How do they trust the messages?
Exactly. And Satoshi Nakamoto's paper in 2008, just 9 pages, laid out a system. And for the first time ever, it allowed value to be sent quickly over huge distances, completely trustlessly.
Trustlessly. What does that actually mean in simple terms?
Yeah.
No bank needed.
Precisely. No bank, no government, no PayPal, no central anything. The network itself, using cryptography and this shared ledger, it handles the trust part. You don't need to trust the person you're sending money to or any middleman.
That's a huge shift.
It really is. It changes how you can even think about sending value.
And this is where it gets really interesting for me and probably for you listening. Digital scarcity. How does that even work? Digital things are usually infinitely copyable.
That's the absolute key point. Bitcoin created something new, a scarce digital good. It's designed so only 21 million Bitcoins will ever exist, period.
Like hard-coded.
Hard-coded. Think of it like a digital gold mine, but one where we know exactly how much gold is left and exactly when it will be mined. The process, mining, involves computers solving these tough puzzles.
Verify transactions, right?
Right. Verify transactions, add them to the public ledger, the blockchain, and as a reward, they get new Bitcoins. But, and this is crucial, every 4 years or so, that reward gets cut in half. It's called the halving.
Ah, I've heard of that.
Yeah. So if you look at the Bitcoin inflation versus time graph, you see it clearly. The red line, the inflation rate, it just dives over time. And the blue line, the total supply, creeps up towards that 21 million limit and basically flatlines around 2140.
Wow. So it becomes almost zero inflation eventually.
Exactly. Unprecedented digital scarcity. So its value isn't from gold bars in a vault or a government promise. It's game theoretic.
Game theoretic, meaning?
Meaning its value comes from the collective belief. People value it because they believe other people will value it in the future. It's like a game everyone agrees to play by the same rules, creating this powerful network effect. It really challenges what backing money even means.
Okay, so to really get why this digital scarcity and trustlessness matters, we need to zoom out, right? Look at the history of money itself. This isn't just tech. It's maybe a new chapter in a really old story.
You absolutely nailed it. To appreciate Bitcoin, you kind of have to go back to the beginning. Barter, right. Super inefficient. You need that double coincidence of wants.
Yeah, I have apples, you have fish, but you don't want apples today. Nightmare.
Total nightmare. No wonder we moved on. Humans started valuing certain rare things, shells, beads, shiny rocks, collectibles. Nick Salebo wrote about this. They weren't great for daily shopping, but amazing for storing wealth, passing it down, or trading between tribes, even enemies.
So like proto-money, more about wealth preservation.
Exactly, very low velocity. And figuring out which collectible would hold value gave societies a huge edge. Eventually, societies kind of converge on one main store of value. Game theory Again, a Nash equilibrium, it just makes trade easier. And when trade routes opened up, this process accelerated, leading to gold becoming the standard in the 19th century, fueling global trade.
And over time, certain qualities just became essential for something to be good money, right?
Yeah.
What makes a good store of value something that lasts?
Yeah, there's a classic list of attributes. It needs to be durable, doesn't rot or fall apart, portable, easy to move and secure, fungible, one unit is the same as any other, like an ounce of gold. Then, verifiable, easy to check if it's real. Divisible can be broken down into smaller units. Scarce, this is huge. Sabo called it unforgeable costliness. Can't just make more easily.
Right. Scarcity seems key.
Absolutely. Then there's established history. The longer society values it, the more trust it has. And finally, something really relevant today, censorship resistance. How hard is it for someone like a state to stop you from owning or using it?
Okay, that's the checklist. So how does Bitcoin measure up against these? Especially compared to, say, gold or the dollars in our pockets. We've got that comparison table handy.
Right, looking at the table, Bitcoin knocks it out of the park in some really crucial modern areas. Portability, A+. You can send millions across the world almost instantly. Verifiability, A+ is. Cryptography makes it mathematically certain.
Divisibility, too, right? Down to tiny fractions.
A+ again. Way more divisible than gold or cash. And scarcity, A+ AC. That fixed 21 million supply is mathematically guaranteed. Nothing else is quite like it. Gold is scarce, sure. But what if we find a huge new deposit or asteroid mining takes off?
Yeah, good point. And fiat currencies.
Fiat gets an F for scarcity. Governments just, well, they tend to inflate the supply, don't they? Bitcoin also gets an A for censorship resistance, which is massive for people under capital controls or oppressive regimes.
Okay, so it scores really high on these digital age attributes. But what about the others? Durability, history.
Well, gold gets the A+ for durability and, crucially, established history. Bitcoin is still young, so it gets a D for established history on that chart. That's its main weakness compared to gold right now.
But wait a second. Gold has thousands of years of history. It's the undisputed king of durability. Bitcoin's, what, 15 years old? Isn't that a massive strike against it? How can this digital thing possibly compete with something that's literally outlasted empires? A D versus an A+ seems like. Game over for the digital gold idea, doesn't it?
That's a totally fair point, and it's probably the biggest hesitation for many. Gold's A+ history is undeniable. It's deeply embedded in human psychology and culture. Bitcoin is incredibly young in comparison.
So how does it overcome that?
Well, a couple of things. While its history is short, look at what that history contains. Bitcoin has shown incredible anti-fragility. Think about it. It's survived countless hacker attacks, regulatory crackdowns, obituaries written by the media.
Declared dead hundreds of times.
Exactly. And yet the network just keeps running, keeps growing stronger. That resilience builds a different kind of trust. And there's this concept called the Lindy effect.
Lindy effect.
Yeah, basically for things that don't have a natural expiration date, like technologies, ideas, or money, the longer they've already existed, the longer they're likely to continue existing. So every year Bitcoin survives and operates makes it exponentially more likely to survive the next year. That trust versus time graph shows this trust grows asymptotically, it ramps up.
Okay, so survival breeds confidence.
Precisely. It doesn't have millennia of history, but it's building a powerful track record in a world that desperately needs its other strengths. That portability, verifiability, divisibility, absolute scarcity, and censorship resistance. These are becoming incredibly important advantages in our digital, globalized world.
Okay, that makes sense. It's building its own kind of credibility through resilience. So how does this journey, this monetization process, actually work? Is there a typical path money follows?
There is, yeah. William Stanley Jevons, an economist, laid out 4 stages. First, something starts as a collectible, valued for its unique properties. Think rare stamps or art, or Bitcoin in its early days.
Right.
Then it becomes a store of value. People hold it primarily to preserve wealth over time. This is arguably where Bitcoin is transitioning now. After that, it might become a medium of exchange used widely for buying goods and services. And the final stage is unit of account, where everything is priced in it.
And sometimes people try to use it for the wrong stage too early, right? Like that famous story.
The pizza guy. Laszlo Hanyecz.
Yeah.
Yeah, trading 10,000 Bitcoins for 2 pizzas back in 2010.
Which are now worth, well, a fortune.
Hundreds of millions, yeah. It perfectly illustrates the huge opportunity cost of using Bitcoin as a medium of exchange back then. It was still really just a collectible, barely starting its journey towards being a store of value. Most people didn't grasp its potential yet.
So it's still mainly in that store of value transition phase.
Largely, yes. Becoming a widespread medium of exchange will likely take years, maybe decades more. It's a fascinating process to watch in real time, honestly. We haven't really seen something purely digital gain monetary value like this on a global scale before.
Which brings us to the price swings. People hear Bitcoin, they see the crazy charts, and they immediately shout bubble. Is that fair? Is it just digital tulips?
You know, bubble is often thrown around as an insult, but it's actually kind of accurate, though maybe not in the way people mean it. The key insight is that all money fundamentally has a monetary premium.
Monetary premium.
Yeah, it's the value something holds beyond its basic use value. Okay, here's a metaphor. Think of a new, super strong building material. Its use value might be just for, I don't know, basic structures. Simple enough.
Okay. But then everyone starts believing it's the absolute best material for building earthquake-proof foundations. Suddenly, its price skyrockets, way beyond its simple use value, that extra value. That's its monetary premium, driven by collective belief that it's the best thing for that critical job, in this case, safety and stability.
I see. So money is similar.
Exactly. Money, whether it's gold, dollars, or Bitcoin, is always and everywhere a sort of bubble of collective belief. It's a shared story we all agree on for storing and exchanging value. The monetary premium chart shows this really well. Bitcoin's value is almost entirely monetary premium right now. Gold and silver also have big premiums on top of their industrial uses.
So that premium, based on belief, is what makes it volatile.
Partly, yes. Because it's not anchored to immediate industrial demand, people look to past prices to figure out what it should be worth. This creates path dependence and leads to these cycles of boom and bust as beliefs shift and new people come in.
So those wild swings, massive ups and downs, they're not just random noise. There's a pattern. Not random at all, according to this model. The monetization process seems to follow these repeating fractal patterns. Each big cycle looks a lot like the classic Gartner hype cycle for new technologies.
Right, I've seen that curve. Starts with excitement.
Exactly. You get the technology trigger, then the huge run-up to the peak of inflated expectations as early believers pile in, then, inevitably, the crash into the trough of disillusionment.
When everyone says it's dead again.
Pretty much. But then, if the fundamentals are sound, you get the slow climb up the slope of enlightenment toward the more stable plateau of productivity. And the S-curve of adoption chart shows how each cycle pulls in a bigger wave of people, first cryptographers, then early adopters, then retail, maybe institutions, then the early majority.
And this isn't unique to Bitcoin.
Nope. Gold actually followed a very similar hype cycle pattern between the late 1970s and the early 2000s after its price was decoupled from the dollar. It suggests this is just how societies figure out the value of a new monetary good. The cycles end when one wave of potential buyers is exhausted, paving the way for the next bigger wave.
Okay, looking forward then. What's the really big picture vision here? And what are the major hurdles still in the way?
Where one really ambitious idea is hyper-Bitcoinization. That's where Bitcoin could potentially replace a failing national currency, especially during hyperinflation, like we saw with the Zimbabwe dollar. It's an extreme scenario, but possible.
And maybe less extreme.
A more likely path is nation-states starting to add Bitcoin to their foreign reserves alongside gold and dollars. That has huge geopolitical ripples. It could challenge the U.S. dollar's exorbitant privilege, something Charles de Gaulle complained about decades ago, and the Wall Street Journal noted could threaten central banks' monopoly.
Interesting. And what about common criticisms? Volatility, fees, competition?
Good questions. Volatility, as we said, tends to decrease over time as the market gets bigger and more liquid. It's actually lowest during those plateau phases of the hype cycles. Transaction fees, people complain they're high, but fees are what pay the miners to secure the network. Low fees would actually mean low security, which you don't want.
So how do you use it for small stuff like coffee?
That's where second-layer networks come in, like the Lightning Network. They're built on top of Bitcoin for fast, cheap, everyday payments. Here's an analogy. Think of 19th century gold. You didn't haul heavy gold bars around for every purchase, right?
No, you use paper notes like IOUs or banknotes representing the gold.
Exactly. Those notes were the second layer. Lightning is similar for Bitcoin. You transact quickly and cheaply using these channels, settling the final balance on the main heavy Bitcoin blockchain less often. It makes small payments feasible without sacrificing the base layer's security.
Okay, that makes sense. And competition, all those other cryptocurrencies.
Yeah, the altcoins. While there are thousands, Bitcoin has a massive advantage due to the network effect. It has the most users, the most liquidity, the biggest and most talented developer community by far, and the strongest brand recognition. It's like social media, hard for a newcomer to displace the leader once those network effects kick in. Even when people try to fork Bitcoin, creating clones, the market cap tends to stick with the original chain supported by the core developers. That network effect is incredibly sticky.
Okay, even with all that, the resilience, the potential,
Yeah.
what are the real concrete risks someone needs to understand if they're looking into this? Let's be grounded.
Absolutely crucial. There are real risks. First, protocol risk. This is the small but non-zero chance that a fundamental flaw is found in Bitcoin's core code, or the more sci-fi risk of quantum computing becoming powerful enough to break its encryption.
Is that likely soon?
Most experts think practical quantum attacks are still quite far off, maybe decades, and developers are already working on quantum-resistant algorithms. But it's a long-term thing to watch. Second, exchange shutdowns. Bitcoin itself is decentralized, but the places you buy and sell it for dollars or euros, the exchanges are centralized and vulnerable to regulators shutting them down.
So governments could try to block the on-ramps and off-ramps.
They could try. A coordinated global shutdown would definitely hurt adoption, but then you have jurisdictional arbitrage exchanges just move to friendlier countries. It's a cat and mouse game. The hope is Bitcoin becomes too widespread, too integrated for a shutdown to be politically viable, kind of like shutting down the internet.
In the last one.
Fungibility issues. Because the blockchain is public, you can trace coins. If some coins are linked to illicit activity, they could become tainted, and maybe regulations could stop businesses from accepting them. That would damage fungibility, the idea that any Bitcoin is as good as any other. So improving privacy on the base layer is important, but it involves complex technical trade-offs developers are still working through.
Wow. Okay, that was definitely a deep dive. We've covered so much Bitcoin as this unique, scarce, digital thing, how it's following this historical path of monetization, its strengths, its weaknesses compared to traditional money, and this whole journey it seems to be on.
Yeah, and the paper wraps up with this really provocative thought. Could Bitcoin, maybe 50 years from now, become that neutral global monetary base, something like what de Gaulle wanted for gold, free from any one country's control? It's a huge vision.
A world reserve asset not controlled by a single nation.
Exactly. And even if that massive vision doesn't fully play out, just understanding Bitcoin, its properties, its potential, it forces you to question your basic assumptions about money. What really gives money value? And where will that value live in our increasingly digital future? The paper calls it an asymmetric bet, potentially limited downside for an individual, but maybe world-changing upside.
A really powerful question to end on. Thank you so much for guiding us through all that complexity. It's fascinating stuff.
My pleasure. It's a topic worth digging into.
Absolutely. So if you enjoyed this exploration, please do follow, like, and share this deep dive. It really helps others find the show. And for more insights like this, you can follow What Bitcoin Taught Me on Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. Until next time, keep digging.